The rents just all of a sudden overnight just flew up.
Home prices have been falling as a result of interest rates that are currently more than twice what we saw in 2020 and 2021, as well as a substantial reduction in buyer demand. Do these 2 years of record-breaking sales activity indicate that housing market is about to crash? The hot housing market started to cool off last summer and is now crawling, partly due to an increase in mortgage interest rates after 2 years of brisk home sales and rising home prices. When the 30-year fixed rate reached 4% in March 2022, the upward trajectory of rate hikes started. The 30-year fixed rate rose to 7%, its highest level in 20 years in October, and has remained there till 2023. In a report from 2022, the Federal Reserve Bank of Dallas noted indications of a brewing U.S. housing bubble. The analysis concluded that although the rapid rise in housing prices does not suggest a bubble, there are still other important elements to take into account. Among the economic causes for continuous real house price increases are shifts in disposable income, the cost of credit and access to it, supply disruptions and rising labor and raw construction material costs. The Dallas Fed analysis found that the housing market deviates from such fundamentals when there is widespread belief that today's robust price increases will continue. If any purchasers hold this opinion, purchases motivated by a fear of missing out may increase prices and raise hopes for significant increases in home values. Len Kiefer, Freddie Mac's deputy chief economist, doesn't think there is a housing bubble in the United States. According to Kiefer, a bubble has 3 defining characteristics. Price growth is driven by speculative activity. Bubbles are fueled by credit expansion, and bubbles pop. Record low mortgage rates and a fundamental shift in housing demand were the main drivers of the growth in house prices in 2021, not speculation or credit expansion, according to the report. But what about homeowners who purchased a home during or before the pandemic and are now witnessing a drop in their property values? If you purchased a home for $300,000 3 years ago, you could have sold it for $500,000 last year, but now you can only command $400,000, according to Keith Gumminger, vice president of the mortgage website, hsh.com. However, he is hesitant to label this a bubble pop or a crash. It is a paper loss, but not an actual loss, Gumminger claims. The lending criteria are much stricter now as a result of lessons gained and new rules implemented following the last crisis, which is one of the distinctions between the current housing market and the housing disaster of 2008. In essence, this suggests that mortgage applicants now are less likely to default than those who applied during the pre-crisis lending era. According to Kiefer, the housing market was propelled forward by rapid credit expansion, rising leverage, and overly optimistic household expectations for house price rise. After an initial fixed-rate period, the interest rate on an adjustable-rate mortgage, ARM, fluctuates on a regular basis in contrast to a fixed-rate mortgage. After an initial fixed-rate period, the interest rate on an adjustable-rate mortgage, ARM, fluctuates on a regular basis in contrast to a fixed-rate mortgage. According to Kiefer, homeowners who obtained ARMs before the 2008 financial crisis experienced payment shock when interest rates reset, and many of them were unable to afford the higher monthly payments. This highlights yet another significant difference between 2008 and the present. As Kiefer notes, the majority of borrowers now hold fixed-rate mortgages. Due to this, even though mortgage rates have doubled, current homeowners' monthly principal and interest payments have remained the same. There are many more homeowners today who have equity in their homes, which can help them weather a downturn, which is another significant contrast between the housing market today and the housing crisis of 2008. By the end of 2009, about a quarter of American homeowners had negative equity, which means they owed more on their mortgages than what their properties were actually worth. According to recent data, close to half of all mortgaged residential properties in the United States are deemed to be equity-rich, meaning that the total estimated value of the loans securing such properties is at or below 50% of that value. According to a recent CoreLogic data, borrowers' equity actually increased by 7.3% in Q4 2022 compared to the prior year. According to experts, the housing industry is in for a difficult year because of a number of factors, including high mortgage rates, inflated home values, weaker buyer demand, and a recession. Selma Hepp, deputy chief economist at CoreLogic, claims that many prospective buyers are priced out of the market or hesitant to buy a home out of fear of home price drops, because mortgage rates are at their highest level since the early 2000s and affordability is at a record low. Additionally, according to HEP, many people who purchased homes in the previous 2 years and secured extremely cheap mortgage rates are unlikely to do so anytime soon, which will put extra pressure on the supply of homes on the market. The Federal Reserve's efforts to curb inflation, which erupted in 2021 and has since soared to 40-year highs, are partially to blame for the increase in mortgage interest rates. Since January 2022, the Federal Reserve has aggressively increased the federal funds rate, or the interest rate at which depository institutions, such as banks and credit unions, exchange federal funds 10 times. Although the Fed indicated at its meeting in May 2023 that it would suspend rate increases in the immediate term, more rate increases are probably on the way. According to Joel Kahn, Deputy Chief Economist at the Federal Reserve, the Federal Reserve's continued efforts to contain inflation and ongoing affordability challenges will slow homebuyer demand and purchase origination volume in 2023. Because the Fed's rate decisions affect borrowing costs, which in turn have a direct impact on mortgage rates, the Fed's actions have a significant but indirect impact on mortgage rates. The home market is crashing, according to Diane Swunk, chief economist at KPMG, in a recent NBC News interview with Chuck Todd. She noted the Fed's quick rate increases and the housing market's cooling because it was unaffordable despite inventory shortages. Other experts, however, don't agree with this assertion and don't believe that the current circumstances will result in a home market meltdown. 5% to 6% higher than they were at this time last year, according to Redfin's chief economist, Daryl Fairweather. I don't think that qualifies as a crash, you say. They're down from earlier this year, but they're still above what they were last year. According to Fairweather, homeowners who purchased their home in 2020 or 2021 should not be concerned. Even though your home's worth has decreased slightly, it is still higher than it was. Another distinction from the years preceding the housing meltdown of 2008 is that buyers have put down more money on homes over the past 10 years. Many homeowners now have significant accumulation of home equity, which serves as a financial cushion in case there is a recession or they lose their job. HEP adds, this is because of the increase in home prices. In the current market, potential home buyers have many difficult decisions to make. According to predictions, new home construction will trail for the foreseeable future, even though inflated housing prices will start to drop in the coming months. Insufficient housing supply might drive up home prices if demand picks up, locking many people out of the market. Although economists have varying predictions regarding when and how likely it is that we will have a recession, they all generally concur that it is coming. Analysts anticipate a reset. Longer-term rates, particularly mortgage rates, will start to decline from present peak levels as the economy slows, according to Kahn. For some consumers who are now looking to purchase a home, this entails leaving large cities for more affordable metro areas. Others may have to stretch their finances or make concessions about the size of their homes or other amenities. But what if you're not yet prepared to make a property purchase? Is there anything you should be doing right now to get ready for when you're ready to start looking for a home again? Bulk up your money, strengthen your credit, and look at towns and areas that might fit your demands, advises Gumminger. But don't count on being able to time the market and predict when mortgage rates will drop. This is a tricky skill, advises Kiefer. Instead, I advise potential purchasers to think long-term and to take into account both their current and potential future home demands. According to Kiefer, you should think about your credit score right now and what you can do to raise it, as well as determine whether you have enough money saved up for a down payment. He also advises enhancing your borrower education by utilizing initiatives like Freddie Mac's Credit Smart. Please remember to like, share, and subscribe if you found this video to be interesting and thought-provoking. As we continue to examine the fascinating stories that define our world, keep checking back for more engrossing material.